7:30, so let's start. I went out and Googled a little bit on Damodaran, and he does, I mean, it's amazing. He's got a lot of stuff for free out there, just to show you some stuff. Pretty amazing. So he has a PowerPoint or a PDF where he goes through the equity risk premiums. So remember with CAPM, you got the risk-free rate, beta, and the market risk premium. Damodaran, you know, I don't think he publishes much on beta as much as he does the risk-free rate and the market risk premium. But this is a really good synopsis of the equity risk premium. He does it by country, which I think is pretty amazing. We're doing all U.S. companies, so so what he does is he goes through, similar to what I told you about that J.P. Morgan approach, the different ways people can actually estimate the risk premium. So the survey approach, which I don't particularly care for that approach. The historical approach, which used to be the standard for the longest time. That's where you see Dr. Ibbotson. The looking forward approach to me is a little bit bizarre because you're using the stock market and a dividend discount model to back into the equity risk premium, which means your assumption for growth is correct. I mean, it's like you're using a very unreliable number to predict a very unreliable number. So you've got two huge assumptions in there. And then he does the bond default spreads. That's definitely one I've seen in others. He shows it by country, but he uses the implied approach. So here's his implied approach. So yeah, you can look at, you know, in the implied approach, you can see what his equity risk premiums have been throughout time. So you can see he has unusually high equity risk premiums right now at a time when the VIX is not particularly high. And this isn't just 2020, this goes through 2019, but he had a really high equity risk premium at the end of 2019, even though the VIX was really, really low levels. So anyway, that presentation's out there. And then on the internet, it's even more amazing. Just he has these websites. Well, here, let me show you something he provides in Excel. Shows you his equity risk premium over time. It looks like it's coming down, but the equity risk premium is not coming down. The risk-free rate's coming down. You can see his really low risk-free rate. So he uses the actual 10-year treasury. And because he's using the implied approach, just because a 10-year treasury is down, he doesn't assume stocks will keep making the same return they've always made. So he's bringing those assumptions down. He does adjust for dividends and for stock buybacks. That's in part of his numbers in there. But if you look at this, you know, this number across, he's got stocks making less than 6% as his base case. So his expected, and that's his it's not his earnings growth, that's his expected total return on stocks is 6%. That's a really low return. I don't know anyone would be excited about taking the volatility of the stock market to make a 6% return, especially given what you can get municipal bonds for and some other things that, you know, have pretty decent yields. But anyway, you can see over time he's been pretty consistent around that 8% return, but the last few years he's been coming down on his assumption. Part of that's because dividend yields are coming down, but you think that would have been offset with the buybacks, but he's just coming off of his assumptions. So he has that out there as well. This goes through 2020 too. So, and then on the internet, just to show you what all he has on the internet, which is pretty amazing. If I can find the internet, boy, I can't tell which is the internet and which is not. So, all right. So here's that presentation I just showed you. Here he has risk premiums by country. He adjusted for the credit rating of the country, and he also makes some adjustments for currencies and other things. So he gets a country risk premium, and then he has an equity risk premium. So, you know, it's, you know, you look at the credit rating, obviously there's going to be a high correlation between the credit rating and the country risk. So you have a country like Albania that has a B1. They have a really high country risk premium and a very high equity risk premium. You have a country like I can't say that firm, but AA rated firm, very, very low risk premium, probably similar to the US. So you get to the US, you can see his numbers for United States, AAA rated, no country, no country adjustment, but there's the equity risk premium 5%. I don't know what the date for this is, but he probably has it at the top. This is the most recent one. So yeah, July 2020. So remember this. You may have a class, maybe your capstone class, where you might be dealing with a non-US company and you need to do some valuations. Don't forget that Damodaran has this out there. It's as good of a source as you can find anywhere. And you actually add the country risk premium and the equity risk premium on top of the 10-year treasury. And the reason you do that, the country risk premium reflects the currency risk. And so you're investing in currencies outside the US. The country risk also implies other things like government policy and those kind of things. The equity risk premium is simply a reflection of the systematic risk of those countries. But that data is available and he publishes it and he's highly respected. So you're not going to get any harsh criticism. And then here's his online, which he updates this all the time. And you look down here, he has an implied ERP by month. And you can click on that. And it's going to essentially give you what I've already shown you. It's that Excel model where he shows his ERPs. So you get that data. I mean, you're welcome in your paper for paper 6 if you want to quote Damodaran. I'd like for you to use the implied approach. So you can't just use his numbers, but you can certainly check your numbers against his numbers and give yourself some confidence. But look at all the stuff he's providing for free here. My annual update paper on ERP. There you go. I mean, that would be good. You could quote from that. He's got, I mean, how many pages is this going? And he is famous for just providing a bunch of stuff for free, which I love. And I kind of do the same thing. I provide stuff that people all over the world ask me for. I'm not quite as highly regarded as Damodaran, obviously. But boy, he just provides so much stuff for free, and it's all down here just at a click. Any questions on Damodaran? I mean, just incredible stuff that you can click on for free. You could use it in this class. You can use it in other classes. What I couldn't find was any update on the risk-free rates. So as far as I can tell, he's still using the 10-year treasury. He's not pulling off of that at all. The article I linked in the notes is probably his same argument, even though that article is pretty old. So his risk-free rate is the 10-year. Remember on that, I said you could normalize it. I don't like to normalize it anymore because the 10-year has been so low for so long. But I do like the forward curve, just especially because we're in the middle of COVID-19. And so you got a little bit of a distorted number. But anyway, those are theories you need to develop in paper 6. So paper 6 has a little bit more theoretical bent to it than you would actually do in a real life research report. But still, you have to come up with these assumptions. It'll be interesting if you get a job as a security analyst, how your firm actually does these assumptions. Is there a number that they hand to you? When I was at UTSA as a security analyst, it was a free-for-all. I could use whatever I wanted to. They didn't dictate to me and it was easy back then because everybody knew. So it probably wasn't as big of a deal back then because we all used the 10-year treasury back then because it was 5-6%. And we all used the historical approach. So back then it was a lot more straightforward because there weren't that many choices. Today it's not. So, it's questionable if some firms are a little pickier. It'd be interesting if some of y'all get to work for JP Morgan or Goldman Sachs, what their assumptions are. JP Morgan publishes a paper very similar to Damodaran's. But whether or not that paper for JP Morgan is dictated throughout the company that everybody must use those assumptions, that I don't know. So there's plenty of resources out there. And Damodaran is a good place to go, really is. Damodaran and Ibbotson. Ibbotson is IBBO, but IBBOTSON. Ibbotson. He's the other guru when it comes to the market risk premium. Ibbidson's articles are a little bit more academic, so they're maybe not as fun. I think Demodaren keeps it very practical for actual people making decisions versus Ibbidson is writing for the academic community, so his papers can be a little bit technical. There's a fly flying around me, so if y'all see that, it's really bugging me to death here. I want to kill that thing. I'm not a violent person, but I love killing flies when they're in my house. So if you find that I'm a little distracted, that's what's going on. All right. Last thing I want to talk about is beta. So some of you have had me before. So remember on beta, let's take it out there again. So you've got the first thing is what kind of firm is your firm? So here, what we're looking at is, you know, the revenue sensitivity. That's where you're deciding if your firm is cyclical or defensive. So that hasn't changed. You're going to do that. The second thing is operating leverage. That's where you're going to decide about the fixed cost. The third one is financial leverage. That's where you talk about the debt. And the last one is the history. So on the second and third one, I have a file. I don't think I put it out there on Blackboard yet because I was going to update it, but it looks like I won't be able to update it. I don't think it matters that I update it because I updated it last spring, and I don't really think, I'm not sure I want to put the COVID-19 numbers into this spreadsheet and just mess it up. So what this spreadsheet does is, first of all, answers number 3 on financial leverage. It shows your firm's financial leverage versus, it says versus the S&P 500. I should change that because it's actually the Russell 3000, which is fine. You're supposed to do beta against the S&P 500, but I do against the Russell 3000 just because some of your firms are not in the S&P 500. So, and so very simple. Look at their debt to equity. For Costco, it's 50%. The typical stock is 72%. So they're below average. So that gives you an argument for potentially reducing their beta. If I show you Kroger's, I was talking last time about Kroger's and how high. So all you do on this spreadsheet is you just go to this green cell, hit the equal, go to the second page that says paste values data, and just go down alphabetically until you find your company. So I'm looking for Kroger's here. So there's Kroger's right there. And you can see how high their debt is. They rank almost in the top 10%. So you can use this Excel file and your paper 4. Don't forget about paper 4. Remember paper 4, you have an entire section there about debt to equity and debt to EBITDA and those type of things. So you can bring those charts in, those charts that you use in paper 4, you can bring them back into paper 6 to talk about your firm's beta. But I like this one. This one's the most theoretically correct because you're comparing your firm's debt against the entire stock market, not just against this industry. But obviously Kroger has high debt versus the market and versus this industry. There's no question on that. Other firms, I mentioned Ford as well, having really high debt. Some of these numbers, Ford is pretty shocking how high it is. So it's alphabetical, not by firm name, but by ticker. So you can see Ford's almost the top. They used to be the most indebted. So some others have caught up with them and gone ahead of them. So here you have Ford, which is obviously a very cyclical firm with this tremendous amount of debt. Now, some of that may be related to Ford Motor Credit. So essentially they are a bank, and banks tend to be highly levered. But that's a really high number, 441%. No bank is that levered. Banks are usually levered, 10 to 1, not 400 to 1. So that's a pretty, well, I guess I'm thinking that wrong. Maybe that's 4 to 1 instead of 10 to 1. So maybe that's not that outlandish for a firm like Ford, but it's a pretty high number. If you compare it to GM, that's the other thing you can do with this file is you can compare it to a competitor. So if you want to see, well, how does my firm look versus a competitor in industry? You can see Ford has higher debt than GM, but they both have tremendously high debt. But again, GM has General Motors credit, GMAC I forget what all that stands for, but they have a credit arm as well. So that may be distorting their numbers a little bit. So the spreadsheet, it's set up. All of your firms should be in here. I can't think of any of your firms that are so small they wouldn't be in the Russell 3000. But if for some reason your firm's not in there, let me know ASAP, and I'll add it in as soon as I can. All right. Any questions on debt to equity? I mean, it's very subjective. In the notes, I gave you the actual formula, which shows you how you adjust beta for debt to equity. But I'm not even asking you to do that. I just want you to look at it and combine it, because number 1 and number 2 and number 4 are all subjective. I don't see any reason to get mathematically precise on number 3s. So I would look at their debt, and if their debt's higher than average, like Kroger's, maybe use a 0.5 beta for Kroger's, but you see their debt and you push them up to 0.6, 0.65 or something. It's a subjective adjustment that you make. If you want to use the formula, you could certainly experiment a little bit with the formula if you wanted to. It gets a little tough exactly how you go from unlevered to levered, but you could certainly experiment with that. But any questions on the financial leverage? So I do give a few extra points if you do this analysis for more than just your company. Just, maybe if there's a key competitor and you want to just argue. So same thing with the historical beta. So let's say Kroger's has a whole lot more debt, and so you do their historical beta. Maybe you compare that against a competitor, although Kroger's is running out of competitors. Most of their competitors are either private, or they've gone out of business, or they're like Walmart and they do a lot of other things besides groceries. So it's hard to find one. But if your firm has an obvious competitor, it doesn't take that long. We'll do the rolling beta tonight, so you can see it doesn't take that long. So you could definitely do analysis of your company versus others in the industry, and I think that adds a lot of power to your paper. All right, the next one is operating leverage. So for operating leverage, there's a couple of things going on here. I'm going to look at margins, and remember from the notes, we got the gross margin and we have the net margin. And what I'm looking for here is operating leverage has a few aspects to it. One of it is price elasticity, demand. So how sensitive is your company's customers to price rises? Are they real sensitive or not? If a firm has really high price elasticity, I'm going to say they have higher betas. And so this gives you higher means higher beta and higher standard deviation of gross margins. That's my assumption. So the first part's not. If a firm has very high elasticity of demand, so when they raise their prices 2%, their volumes fall 5%. You remember that from your economics classes? That's high price elasticity. You raise your prices 2%, you lose 5% of volume, you're going to get crushed. Firms like that should have very volatile gross margins. A firm like a tobacco company, their customers, maybe there's an addiction issue, they're going to pay whatever, no matter what the taxes are them. That's the reason governments love. Governments say they love taxing cigarettes because they're worried about our health, but they love taxing cigarettes because people keep spending even though the tax is there. So it's a really great revenue generator. So people pay no matter what. So that's a low price elasticity of demand. So they should have, a firm like Philip Morris should have fairly stable gross margins. I'm not always sure of that. And so we could always check and see if that's the case. In fact, I can put Philip Morris in here and we'll see. Philip Morris is doing more than just cigarettes now. So it could be a little bit distorted. But I'm going to assume maybe they have lower volatility. See, I can embarrass myself here. That's fine. I'm just guessing off the top of my head. That's why you got to do the analysis, right? And see, I was right for a change here. See, Philip Morris's gross margin standard deviation is very, very low, exactly what you would expect. So that's the gross margin. On the net margin, you have the price elasticity of demand flow through. So if your price elasticity is very high, you're going to have volatile gross margins, which is probably going to give you volatile net margins. But you also have the fixed costs. So high fixed costs, again, mean higher beta and higher standard deviation of the net margin. So if we look at Philip Morris, not only is their gross margin very, very stable, but their net margin is extremely stable. They rank in the top 10% on their net margin. And so that's part of my assumption. Now remember when you're talking about operating leverage, remember last class I gave you some subjective things to talk about. You know, is their employee base salaried, or is it hourly? Do they have unions? They have a lot of property, plant, and equipment. Those kind of things can go in there. So, you know, always think through that. But now I've been a little surprised. If I put Ford or GM in here, you would think that they would have high volatility of margin because of the high depreciation, but they're actually not that high. And I think it's because of the lending arm of their business. So Alan, you might find something similar with Carmax. Let's even try Carmax and just see if I can remember their ticker. I think it starts with a K.
KMX.
Yeah, KMX. Yeah. I tend to avoid companies whose tickers I can't remember. I know that's a terrible reason I made an investment decision, but Carmax I can remember. So yeah, their margins are pretty stable, and that might be their lending arm. If they do a lot of auto loans, that may be the lending arm. One thing you can certainly say about Carmax is there's probably some commissions involved. If you have a lot of sales commissions, that's definitely going to pay per vehicle. It's still, when their sales aren't doing well, they pay their employees less. So you know that's going to give them a lower net margin standard deviation and a lower beta. So there are things offset. Now, not all car dealerships are like that. So I'll show you one that has some really shocking numbers. Let's look at Tesla. Tesla's numbers are almost impossible to stand. If I can find it, boy. TS, there it is right there. So their standard deviation of their margin is 31,000%. That's a pretty high standard deviation of margin. And you can even look at it. Look at Tesla's margins. I mean, not just their net margins. Look at their, where are they? TSLA. I don't know why I went up. TS, there they are. So here's their gross margin. Their gross margin, 88%. That's really good. Then it was negative. How do you have a negative 8% gross margin? 9%, 26%, 30%, 7%, 23%. How can you run a business? Now look at the last few years. They've been much more stable the last few years. Then you look at their net margin. Their net margins are crazy. Negative 109%, negative 533%, negative 46, negative 126. And finally, they started making money, but it's still not in my numbers yet. But, you know, just crazy, crazy numbers. Y'all can see why I told you don't do Tesla. It's just a very, very difficult firm to do. And then on the other side of that, you got good old Costco, which is about as stable as you can get of any company. Whoops. There's Costco, and you can see it in their numbers. Costco is really, those of you doing Costco, you have a huge advantage when you get the paper 5. Because look at their gross margins, 12, 12, 13, 12, 12, 12, 12, 13, 13, 13, 12, 12, 13, 13, 13, 13, 13. Anybody want to forecast Costco's margin next 10 years? I bet you don't say 16%. And here's their net margin: 3, 3, 3, 3, 3, 3, 3, 3, 3, 2, 3, 3, 3, 3, 3, 3, 3, 3. An amazing company. You can see that they actually target a margin. So anytime they save money, they pass it on to price reductions, and they keep a very standard margin. So when you're doing paper 5 for Costco, boy, you got a piece of cake. I mean, it's their net and gross margins are so stable, very, very easy from the forecast. The hardest part is getting their revenue growth. So you already think of Costco as being the defensive company. We already saw that their debt's below average, and you see that their margins are very, very stable. So they probably have very low fixed costs. They probably have a lot of hourly workers. They also have that wonderful thing that I think y'all mentioned is the membership fee, which probably gives them some stability. I bet most people just keep paying that fee. I know a lot of private charitable organizations, boy, they're going to pay their Costco every year because they buy stuff from them for, you know, snacks for their kids, for the students or whatever. So they have a pretty standard base of people that will always pay that fee. So very stable firm, which means Costco probably one of the lower betas out there, probably 0.6, 0.7, maybe even lower than that. I mean, they do sell flat screen TVs and some other things, but that's probably not a big part of their revenue. Groceries is still a huge part of it. And even the clothing, I used to buy clothes there because I'm a really cheap guy. I mean, it's just some massive shirts and you're spending 3 hours trying to find your size, but yeah, I mean, it's cheap stuff that, you know, so it's a different clientele, a very different business. So you see how you can use this report. So what are you going to do here? You know, bring in some stuff from paper 4 for the debt to equity. On the gross and net margin, think about it subjectively. What is your firm like? And then look at these numbers. And then again, try some competitors and see. So if I put Walmart in here, how much different is Walmart than Costco? And so higher debt probably, no, about the same debt, but very, very stable margins, but not as stable as Walmart, but still pretty amazingly stable margins. So Walmart's a pretty easy company to forecast and to figure out. It's interesting that their gross margin is a little more volatile than their net margin. So it sounds like they have some control when their gross margins decline, that they can offset that some way somewhere else. But very, very stable firm. So before I get into history, any question on that? Y'all see what you need to do in paper 6 when you get to the beta of your firm. So you come up with your risk-free rate, your market risk premium, and then you have this 4-step process that you do for your beta. So paper 6 is one of the more straightforward. You just click through the steps. Questions on that? Those that have had me before have seen it before, but some of you new people like Ryan and some of the others, is this sinking in, or you need to still think about it a little bit? Joseph, you even had me before. About half of y'all have had me before. Richard, you had me before. So any of y'all have questions on this approach? All right, let's talk about the history. What I strongly recommend you do right now is you open up Excel, and you have to do this for paper 6. Why not get it out of the way right now? So open up Excel and do exactly what I'm doing, but do it for your company. All right, everybody got that? Everybody ready, or do you need a few seconds? Have Excel open, have the internet open. All right, anybody need more time? Y'all ready? Thumbs up, Victor, thanks. It's good to know y'all are breathing, so that does help. All right, so we're gonna do this. So do this, get it out of the way so you don't have to worry about it. And in fact, I'll let you do it through October 20th for paper 6. Even though you could have gone through November, whatever. Whatever you create today, you can stick with it. You don't have to change it, and I'll be perfectly fine with that. All right, so let's go to the internet. And so what we're going to do with the internet is we're going to go to Yahoo Finance. Y'all see Yahoo Finance here. Y'all know how to get the Yahoo Finance. Just search for it if you need to. The stock market was up a bunch and then not so much up, and now we'll see if Pelosi can get it done. Anyway. Oh, Netflix shares tumble. There's a stock I might use for my investing class. None of y'all, is someone doing Netflix in our class? Boy, I can't remember. Seemed like there was someone doing Netflix. So, yeah, there's some interesting.
Yeah, I am, Professor Sweet.
Who's that, Jacob? Yeah. So, yeah, obviously their subscriber base is huge, and so subscriber boat, yeah, interesting. All right, so I'm going to do Walmart. So I go and I search for Walmart. And so Walmart comes up. So you have your company there, and right over here, we're going to click on historical data. So click on that. And on historical data, you have the time period and the frequency. Historical prices is what we want. All right. If someone's getting behind, jump in and say, give me a second. All right. I can't see y'all, so thumbs up and thumbs down doesn't work when I'm on like this. So if you're not with me, slow me down. So time period, just click on that and click on max. And take note, you might write down the starting date. So you see for Walmart, it's August 24th, 1972. I'll tell you why we're doing that. So just write that date down so you know what your starting date is. And then on frequency, we're actually going to use monthly. You're going to see some of my videos say to use weekly. And to do 3-year Vedas, we're going to do monthly in 5 years because that's what Yahoo Finance is doing now. So do that. Don't forget to hit apply. So you should have the longest period possible and monthly. Hit apply. And then after you apply, you want to hit download. And then you want to load that file. And then what we're going to do next is we're going to do a search on Carat Shift 6 GSPC. You could click on the S&P, but you notice that the S&P is the futures. And we don't want the futures, we want the actual S&P. So if anyone's not catching up with me yet, hopefully you're okay. So you're back in. We're going to get the market since I'm already sharing the screen for the finance. Yahoo Finance, we're going to do that. So we're going to look for the stock market, Shift 6 GSPC, and click on that. Now, if you're doing this when the market's open, you can actually click on the S&P itself, but since the market's closed, we can't do that. Now, it's showing the same dates I had before, but if it doesn't, what you can do here is when you click on the dates, if your firm started August 24, 1972, then just start the S&P like at July 31st, 1972. Start at the end of the month of the previous month. If you don't do that, if you do the max, it goes back to like in the 1920s and you'll have a lot of data you don't need. It's not terrible, but it just wastes some time. So the nice thing about doing these together is it keeps that date there, but if it doesn't keep the date, then just change your starting date to the end of the month before your data starts. And click apply again. And download and bring that in. All right, is everybody with me, hopefully?
You said the month after their first month, right?
Before. So if the first month's August 24th, then do July 31st.
Yeah, no.
Oh, hold on.
You might still be off 1 month, but you can still delete that month. I'll show you. So I'm going to show you in Excel what I have here.
I'm a little lost on this. I mean, we did a GSCP, correct? And once
GSPC. So you have that. Did you get back to this?
All right, historical data.
Yeah, if you do historical data, then you have to, you'll have to pick your own dates.
Daily, monthly.
Make sure it's monthly and historical. You don't want necessarily the max. I mean, you can. You'll just have to delete a lot of rows because it goes back to the 20s.
So October 20th, 2019 through October 20th. So October 20th, 2019 through October 20th, 2020 would be fine for a time period?
No, you need much more data than that. So for your firm, how far back did your firm go? What is your firm again, Nikolai? I can't remember.
Lockheed. It went back like early 20th century.
So if you do Lockheed, yeah, so you do the max. So you go back to January 1977 monthly. So you have that data in Excel yet?
Yes, I have it now.
All right, so now when you do, if you put Shift GSPC up here, it should keep those dates like that. And all you have to do is hit apply and then download, and that will give you the S&P 500.
Gotcha. So once I've did the GSPC and I've applied the time period, historical prices, and monthly frequency, I just I apply it and then I download it.
Yeah, and then download it. You'll have two files, one for your firm. See, I have Walmart. Well, you can't see, but I have Walmart and the GSPC. So you have those two files. Sorry, I didn't realize I'd stop sharing. Boy, I hate this part of Zoom. So, all right. So let me share my Excel with you. So on my Excel, I've got Walmart data. We don't really want this August because it was August 24th. We'll take that out later. What we're going to use is the adjusted close. So I'm going to put my ticker above the adjusted close, so I'll know that's my company. And I'm going to jump over to can y'all see them? I don't know if it switches for y'all. If I switch to another file, hopefully it does. You'll probably still see my Walmart, right? So I'm going to take the S&P 500 data and copy it and bring it over to my Walmart. So here's the S&P 500. I just call it SPX. And what I want to do is line up the dates. So you notice here, the S&P starts 9/1, and for Walmart, I have them at 8/1. So I'm just going to do Control Shift down, and I'm just going to Control X and line those up. So you got to get the dates lined up. You want the exact same months lined up. Here's what I was talking about. If you did the S&P back to the 20s, you have to delete everything up until you start. So your first month for your company, you probably want to delete because it's only a partial month, and line them up. And then I'm going to do Control down. I also want to get rid of the very last month because October is not over yet. But if you look at it, it lines up really well. I got the exact same dates for the S&P and for my company. So I'm going to get rid of everything except for that adjusted close. Just delete those columns. You got the S&P. And so what you want is you want your company's adjusted close and the S&P's adjusted close. If you want to format them so they're easier to read, that's fine. But all right. So hopefully y'all are with me up to there. Anyone having troubles?
I'm having a very long list, so this might take a while.
So yeah, if you're
So
ever
we just to make sure I'm on track, we take the GSPC sheet and we copy and paste it over to the first one, correct?
to your company,
Right.
line up dates so you have the exact same months next to each other. You usually have to delete the first month for your company and delete the last month for both because the month's not over yet. And you get, so I've got Walmart's adjusted close. Again, these are adjusted close numbers. We always want to use the adjusted close. The adjusted close adjusts for things like stock splits and dividends and all those kind of things. All right. What we want to do next to that is the holding period return. And so for the holding period return, what we do is in the second month, not the first month, in the second month, we're going to do the current month divided by the previous month, close parentheses, -1.
Excuse me, but how did you get the? I don't mean to backtrack, but how did it? Well, I am, but how did you get the adjusted close from the?
It's one of the columns.
Right.
So what I did was, yeah, I don't know what I'm sharing. That's the biggest problem I've got with Zoom. So here's the market over here. Column F is the adjusted close. So when I got the adjusted close, I just typed in SPX there. So I know that's the one I want to use. And so when I bring the S&P over and copy and bring it over to the other one, I know that's the only column I want is that column F. You only want the adjusted close. If you don't use the adjusted close, you can get some really distorted numbers. Probably not so much with Walmart, but you can definitely get some issues with companies that have done some unusual dividends. All right, so I'm putting the formula over here on the right. So that's what we want for Walmart. You can copy it over to the market. So the exact same formula for the market. So you just take this month divided by the previous month. Make sure you have the parentheses in there, -1. And essentially what you have is you just have the returns for September 72 for me, but whatever your first month is. I like those two numbers, and we want to just copy them down. See that little green square there? Just double click on that little green square. So you have Walmart's return for a month, S&P's for a month. We want to get them for all months. So I'm just going to click that little green square all the way down. I have returns. Now, some of you might have some errors in the data, so you might check on that to be sure. One thing you can do is just highlight all of your company's stock price and just insert a line graph just to make sure. Because if there's, I've seen stuff like this before where they just accidentally put the decimal in the wrong spot. And when you do that, you'll get something that looks like that. And you have to just go find that one spot. You can just tell this should be 89.6, not 896.4. And you just have to fix it. So you might try that just to make sure. I see it about 5% of the time where you get an error. And the easiest way to find it is just graph your company's stock price and just make sure there's nothing radical going on. I've never seen the S&P wrong, so that one should be fine. All right, hopefully y'all are with me. Now, this is something Yahoo Finance has fixed that I really like. They used to round these off to 2 cents. You know, when you adjust for dividends and stock splits, your stock's price could be less than a penny. And they used to just round it to whatever it was, but now they go out several decimal places, so you're getting a true total return even back that far.
Nice.
So don't let that bother you. Yeah, it's not going from 2 cents to 2 cents. It's going from essentially 2.04 cents to 2.26 cents, which is an 11% increase. All right, the next thing we're going to do is the rolling beta. And so we want to do 5 years. So what we need to do is find 5 years. So 5 years would be 60 months. So go down until you see 60 months. There it is, 60 months is right there. So I'm just gonna mark it, put a 1 there. So this class is being recorded. So if you're having too many technical issues, watch the recording right afterwards while it's still fresh on your mind. Some people are more comfortable with this than others because they've done it before. So if at this point I might just keep going, and then maybe I can do it again. If we finish at 8:30, maybe I can do the entire thing again at 8:30 for those that were having trouble, and we can try it all over again. So yeah, it kind of depends on your comfort with using Yahoo Finance and getting this data in. These are good skills to have, though. So if you're not comfortable with it, get comfortable with it, because this is a really good skill to have. All right, so we brought in the stock prices. We got the monthly returns. And now we're going to do the rolling beta. So I'm on the 60th month. And to do the rolling beta, we're going to do equal slope. And we're going to highlight the 5 years for my company, comma, and the 5 years for the S&P 500, and hit enter. And the slope function gives you beta. So that's the beta for Walmart. Now that looks really, really high, doesn't it? 1.36. But this is when Walmart was a small cap stock, very small company, only sold in rural areas, not that well known. Most companies, when they're small and starting off, most small cap companies have higher betas. But that's just their beta for the 5 years ending September 1977. So let me put that formula over there so you can see it. In fact, I'll put it above the graph so you can see it. So that's just 1 point. Now I'm going to copy that down all the way down to the end, and you're going to see their rolling beta all the way down to the end. I'm going to the very end and look at their current beta. It's 0.27. That's through September. I'm going to go over to Yahoo Finance again and find Walmart and go to the summary page for Walmart. And you see for Walmart on their summary page, their beta, you see that 0.28, real close to our 0.27. You see what Yahoo Finance is doing? They're doing 5 years and monthly, exactly what we're doing. Your number may not be exactly the same because I think they may actually go into the month of October some, where I'm stopping at the end of September. But you can see it gives me a lot of comfort that I did it correctly because I'm doing the exact same thing here. But you can see they only have one number. I'm doing a rolling 5 years back to 1972. They're just doing the last 5 years. I would never use a 0.8 beta for Walmart. That's way too low. I know they did well in 2008 and they're doing well this year, but those were two pretty unusual periods of time. I just don't consider them to be a 0.28 beta. All right, so if I go back to Excel, and the key here is getting the data in. So I brought in Walmart stock price, the S&P, got the monthly returns, and now I'm just doing this rolling beta using the slope function for Walmart. The other thing we want to do is we want to get some sense of history. So we're going to do the median, which is the 0.5. We'll do the 0.1 and the 0.9. So what I want to do is see where has it been 50% of the time it's been above this and below this. Where has it been 10% of the time? Where's it the lowest it's ever been? And what's the highest it's been, the 90th percentile. And so I'm just going to use the percentile function equal percentile. And I'm just going to highlight all of these cells. You can lock it in hitting the F4 function, comma, and go up to the 0.5 and lock in that and hit enter. And you can see for Walmart, let me put that formula up there so you can see it. You can see for Walmart, 50% of the time they've been above 94.94 and 50% of the time below 9.94. Now, I still think that's too high for Walmart, but that's because of its early history. So you might find with a firm at Walmart, you might actually do your chart from a more recent period, maybe from 1985 or 1990, because it's so distorted, but we'll see that when we look at the graph. So I can copy that down. I can also copy it across because I locked in, you lock in the whole row here, and you only lock in, you help the row and column on your range and only the row on your percentile. So you can see 10% of the time, which is where they are today, right? Today they're at 0.27. They're only that low about 10% of the time. So that's a really, really historically low number. 10% of the time they're above 130, but we know 130 is way too high. So I'm going to copy that down. And so we've got some good ranges here for this company. And what I'm going to do is graph the whole thing on Control Shift down and right, and I'm going to insert a line chart. So this is Walmart rolling beta, 5 years monthly data, just so we know. We need to put some dates in here, so I'll go pick the dates. One thing I'd recommend on the dates before I do this is we don't need months and years. So you might add a column and just do equal year and just make it the year, because all you need is the year. And you'll have to reformat it. So format it. I don't usually put a comma in years, so I'm going to make it a number with no decimal places and no comma. So there's my year. And I can copy the years down. And then when I do the graph, and I want to put the dates in there, I can just right click, select data, add it over here on the dates, and just go up to that first date. And just highlight that. And you got your dates in there. And it's going to look a lot better with the years versus the months and the years. So here's my range that Bill Gates has picked for me for some reason. I'm actually surprised there's no negative numbers because Walmart's It's interesting, Walmart's beta on Yahoo Finance was negative for quite a while there, but I think because they switched from 3 years and weekly to 5 years and monthly, that went away. The last thing we need is the legend. So I'm going to select the data and I'm going to edit my legend. So the first one is Walmart rolling beta. The second one is the median. The third one is the 10th percentile. I usually misspell these things. We'll see if I can get it right the first time here. And then the last one is the 90th percentile. And that's your final graph. You have to have this graph in your paper 6. You can obviously move the legend around to where it looks, however looks the best. But let's move this to its own page so we can just see a little bit better. And so I'm going to take this and do a little bit of formatting. Just looks a little bit better, and let's fill it in with some light green. Give it some bold. I like this chart other than I don't like the title up here, so I'm going to bold that. So make it look nice and professional. On the dates, a little bit larger, but we have too many dates in there, so you have to kind of think about how you want them to do in 100. I'm going to try 200. I think that works well. Oh, wait, that's not it. Tick marks. Label position number. Here we go. Interval. Let's make the interval 200. 200 is too much, so let me try 100. 100 is a little much. Let's try 50. So it works pretty well. One thing I don't like, I wish Bill Gates would fix this. I want the last year to be 2020 because that's what I'm going through. I wish he'd give you the ability to select, do it from right to left, but he just doesn't allow you to do that. So my last state should be 2020. I will usually play with it until I can get it to be 2020, and that's just a pain. There's probably some mathematical way I could figure that out, but yeah, it's just not working for me. There it goes. I finally got it. So this is a good final chart. Do your best. I don't count off if you can't get it in at 2020. But if you look at Walmart, you can definitely see when Walmart went from being a small company back in the 80s and early, mid 90s to becoming a big, huge firm. You can see their beta has been really low the last decade. Pretty amazing. I'm still not sure I would use a 0.5 or 0.4 beta for Walmart, but definitely they did extremely well in 2008, and so their beta went down to 0. They've done really well in 2020. You can see their beta coming down again. But yeah, you'll just take this and you'll copy and paste into your paper, and it give you some. That's that last thing. That's the history for your firm. So Walmart, definitely a defensive company, no question. We saw that they had slightly below average debt. They had extremely stable margins, both gross and net. And their history suggests, long-term history is 0.9 something. That's way too high. If we looked at more recent, if we did a median since, I might actually say, let me do the median from 1995. And that might be about 0.6. So I might argue, I usually use a 0.7 for Walmart, but given what's happened this last decade, I might drop it down to 0.6. I don't recommend any of y'all going below 0.6 on any of your stocks. Some of y'all doing Costco. Yeah, Costco is tempting to go down to 0.5, but boy, the reason you don't want a really low beta is it's going to really cause you problems in paper 7, and it's just kind of a problem with low betas. All right, so that's what we're after. So questions on this? We've done all 6 things you need to do for paper 6. You got to talk about the risk-free rate, got to talk about the market risk premium, come up with one, and do this 4-step process for beta, and you have to have this beta chart in there. And then the very, very last thing that you do is you come up with a best, base, best, and worst case. So for Walmart, I might have a best case of like 0.4. My base case might be 0.6, and my worst case might be 0.8. And I'm going to let the history do that, but also just thinking about the company and just how stable they are. All right, questions. Time for questions. I'll do this once more after the class is over. So we'll end a little early tonight, and I'll do this whole thing again for those that couldn't. Some of y'all, you don't want me to do this again because you're in my investment class. You've done this before. So questions, anybody?
And I got a beta of 3.5, and that sounds ridiculous. So I think I did it wrong.
What is your company again?
NVIDIA.
I could see that back a few years ago when they dropped something percent. But again, that's where Yahoo Finance helps you. Look at your very last number. It should be very close to what Yahoo Finance shows in their summary page. All right, it shouldn't be radically off from that. Now, if you get a really radical number, don't waste hours on it. Email me your spreadsheet, and I'm really fast at finding the problems. So just email me your Excel. So if you're spending more than 30 minutes doing this, you're doing something wrong. So put a timer on, and after 30 minutes, send me what you have, and I'll tell you where you're going wrong. All right? I don't want y'all wasting money. Well, I don't want you wasting money, but I don't want you wasting time on this. All right, so that's it for tonight. I was hoping to get started on paper 7, but we'll do that Thursday night. So what I'm going to do now, if anyone wants to stay on, we'll see. I'll do this entire thing one more time. I'll pick another company. Maybe I'll do Target, or maybe I'll do Ford. Ford's kind of interesting. All right, I'll do the entire thing from scratch. All right. Anybody want to stay on to see that, or are y'all going to leave?
No, sir. I'm going to stay.
All right, a couple are going to stay. All right, so if you want to leave now's a fine time to leave. That sounds like a old country western song. Fine time to leave me, but this be a good time to leave me. All right.
I just got confused because I was trying to figure out the right date and just wasn't working out. So.
Okay. So before we do this, let me just give you the steps. So step 1, get historical price data for your company. Max on history and monthly on the interval. Hit apply, hit download, and load into Excel.
Professor, are we going to use this for paper 6?
Am I going to do what?
Are we going to use this for paper 6?
You can. If you're keeping up with me, you have to put it in paper 6. It's one of the required rubrics.
Okay. Well, yeah, that's what I was asking.
All right. And then what you're going to do is repeat for GSP. Oh, I forgot what it is. GSPC. Boy, I can't remember. Let me go back and see. GSPC, right? I never have to type the whole thing because it always comes up. So repeat all of this except for, Bill Gates. Except history should be in a month before first month of your company. All right, so Walmart started August 24th, 1972, so I has to do July 31st, 1972 for the S&P 500. But do the exact same steps for that. You're then going to combine the 2 files and line up the dates. Delete the first month for your company and last month's for your company and S&P 500. reason for that, the first month is probably just a few days. It's not the entire month. And we know the last month's not the entire month. So the S&P will always be the full month. But line up the dates. So get the months lined up. Make sure you have them. If you don't line up the dates, you're going to get a really bizarre beta. The next thing you can do is calculate holding period return, which is just equal current month divided by prior month minus 1. You do this for your company and the S&P, and then you copy that all the way down. All right, so that's pretty certain. Then you got your holding period returns all the way down. Then what you're going to do is you're going to do the rolling 5-year beta. So the first thing you got to do is find the row that is 60 months down in the holding period returns. It's going to be your first 5-year period. So find that. On mine, it was row 63, but it's probably going to be around row 62, 63, somewhere around in there. You're then going to do the equal slope, your company, for 5 years up. So it's going to be 60 rows, comma, the S&P 500. Same thing. All right. You have to do your company first. If you switch those, you'll get really bad numbers. So make sure you do your company, then the S&P 500. That's going to give you one number. So you're going to copy that down. It's only one cell. You don't have two numbers here. You just have one. You're not doing this for your company and the S&P because we're going against the S&P. Copy all the way down. And now what we're going to do is get some ranges. So you do the median, the 10th and 90th percentiles. So you enter 0.5, 0.1, and 0.9 in the columns right to the right and just above your first beta. And then you use the equal percentile. You highlight your company rolling beta and lock in with the dollar signs, comma, one row up to get the 0.5 and lock in the row. So here you want to lock in row and column. Here you just want to lock in the row and do for 0.5, 0.1, 0.9, and then copy all the way down. I recommend you add a column next to the dates and add a equal year. Get the year alone. You might have to format to number, no decimals, no comma. But I recommend you do that because that's what you want to use to make your, well, I don't know why that happened, to make your graph. And then you build the graph. I can't really give you the steps on that. You build the graph, highlighting beta, the rolling beta, 0.5, 0.1, 0.9, and then reference the years and update titles, the legend. I'm stuffing a lot of stuff there at the end. All right, so that's it. You'll have this in the video, so if you're trying to copy all that down, you'll have this and you can do a snip of it. So that's what you're doing. It should not take you that long. We've got 9 minutes left, and I think I can do this in 9 minutes. But let's do Ford. All right, so I'm going to bring Ford in here. You do your company again. I do Ford. So I'm in Yahoo Finance. I've got Ford Motor Company. So I'm going to come up here and find the historical data.
So you're still in the Word file.
Oh, sorry. Yeah, boy. All right, so I got Ford, and I'm going to click on the historical data. On the time period, I'm going to do the max there. Oh, I hate it the way it flips around like that and you end up clicking on the wrong thing. Sorry. All right, so I'm going to click on the time period and do the max. I'm going to write that down just in case I need it. 5/31/72. I probably don't need it because I'm going to pull the market in at the same time. Make sure you do monthly, then apply and download. And I'll load that file so I have it. And then I'm going to do the same thing for market. And here's where you go up to the very top. If you go up to the very top here and just do Shift GSPC and click on the S&P, then you don't have to change anything because it will come in for you. So see, that's kind of nice. I still hit apply. I think you probably don't have to, but I still hit apply. So if you do all this together, you don't have to worry about getting the right dates. So I'm going to download that. Now I've got my S&P 500. So I'll stop sharing that and let me share. Here's my Excel on Ford.
From there.
Remember, I'm going to get rid of that first month, but I'll do it here in a little bit. Remember what columns you need. I don't need the open, high, lower, close. Just highlight those and just delete them. I don't need the volume. So I'm just going to put the F there so I know it's Ford. All right. And then I'm going to go over.
You said we don't need the volume, correct?
Yeah, you definitely don't need the volume. Then I'm going to go over to the S&P 500. Here's the, whoops, I didn't get the right one. Oh, this is going to be tough because I got 2 of them loaded up here. Let me see if I can get rid of the one I don't need. And I don't need Walmart anymore, but I don't want to delete it. So anyway, all right, so let me see if I can get this sharing to work. Yeah, maybe I can't do it in 9 minutes because of Zoom. So here's my S&P 500. So again, I only need the adjusted close. So I'm going to delete everything but the adjusted close. I'm going to mark this as SPX. And now I'm going to, from A1, I'm going to do Control Shift and the down arrow and the right arrow, lift up. Do Control C, the copy. I'm going to take it over to the Ford file and paste it in there. So when we go back to Ford, you can see I got Ford and I got S&P. Remember, we don't want the first month. Actually, for Ford, it'd probably be okay because remember it started 5/31/72. So this one's probably okay. If you want to play it safe, just delete the first month. That never hurts anything. It's only one piece of data. Go down to the very bottom, Control down, get rid of the very last month. We don't need that. Control back up. And we got all our data. If you want to highlight it so that you can see it. See there on Ford, it goes out, you know, very old company. We don't need the dates anymore for the S&P, so we can get rid of that. And so now we got the 2 columns. So let's do the holding period for these 2 companies. So remember, you just do open parentheses equal, open parentheses ending value divided by beginning value, close parentheses -1. Do the same thing for the S&P. You can just copy it over, and you just double click there, and in 5 seconds you got monthly returns for the S&P and for Ford.
All right, can you stop right there just for 1 second?
All right, so you have that formula.
No, that's what I'm trying to get right now.
That's called an holding period return. Just how you do return. And the adjusted close gives you a true total return. That's the wonderful thing about the adjusted close. You don't have to worry about adding in dividends and all that other kind of stuff. It's all there.
Okay, so we will do.
So it's current month divided by previous month minus 1. That gives you a total return for Ford. While you're getting caught up, I'm going to graph Ford just to make sure I don't have any bad data. Yeah, it looks pretty good. Looks pretty pathetic, but it looks pretty good as far as the data. And then you can just copy that over to the S&P.
That's a percentage, correct?
Yeah, I put it as percentage with 2 decimal places. And then you can just copy that.
Does 101 and 33% sound crazy?
What company is it? I don't know. If you're having some wild numbers, keep going and just make sure you subtracted the 1 at the end. That's pretty important.
Yeah, that's probably right.
All right. The last thing we do is the rolling beta. So for rolling beta, go down 60 rows, right? Just kind of highlight them, and at the bottom it's counting. So go down to 60. 60 is on row 62 here. So it's right there. So go down that, so you have that 5 years, and then do equal slope. So you're down 5 years, probably on row 62 if you've done exactly what I've done. And then highlight Ford's number, Control Shift up, comma, highlight your company, close parentheses, and look at that. Ford had a low beta way back then. So the slope function gives you that. And then what we'll do is we'll copy that down. Now you've got your betas for Ford all the way down. And then we'll do the 0.5, the 0.1, and the 0.9. There we'll just do equal percentile, open parentheses, you highlight your rolling betas, hit the F4, comma, highlight the 0.5, hit the F4 a couple of times to lock in. So there's your median, your 10th percentile, and 90th percentile. Let me put that formula up at the top. Some of this stuff, if you're not keeping up, what you can do is, since I'm putting the formulas up there, when you're watching the video, you can pause the video and you can get caught up that way. As long as you put everything in the exact same place I'm putting it, you're going to be good. Now I'm going to mess these formulas up a little bit because I'm going to put the year in here. Remember, I'm going to insert a column right here, and I'm going to make this the year equal year. And I got to reformat that, unfortunately. So format that to be a number without any decimal places, no comma. Then you can copy the year down. So obviously that's going to change my formulas from column F and G to the column D and E. So it's a little bit different. So let me change the formula here so you can see. When you add that column, it does change your formulas to a different column. All right, so now all we got to do, we're out of time. Well, let me finish it up. All you do is highlight all of these and just do insert and graph. And y'all have to change. Y'all can probably get pretty far here without any trouble. You change the title so it says Ford's rolling beta, the median, 10th percentile, 90th percentile. Change the dates. We can real quickly on the dates. You just select data, and over here on the right, you just hit edit. Go to the top of your range and go find those years. Just Control Shift and put that in. So we're getting close. We didn't quite finish, but we got the years. We got the beta in there. You can see their median beta was about I don't know what that is, 1.35. Look how low they got a few years ago. 0.71. I would never, imagine if you're one of those people at UT Austin that just pulls your beta from Yahoo Finance and you were doing a class back in 2018, you would have been using a 0.7 beta for Ford, which would have been absolutely ridiculous. So I would probably use a 1.5 or higher for Ford. All right, so you'll have 2 of these on the video. I'll leave this in the video. I won't cut this section of the class out. So you have this in the video. So you've got 2 practice problems. Something you might try if you're really struggling is to do this with Ford or Walmart so that you're using the exact same numbers I am. And that might help you some. And then you can go back and try it with your firm. Once you see this with the video, if you're still having trouble, again, email me your file and I'll tell you, I won't fix it for you, but I'll tell you what you're doing wrong. You can fix it yourself. Okay. Any last minute questions? I know this is different than what you did in your other classes. Your other classes, if you remember, what they did is they just highlighted the returns for the 2 companies. And they just inserted a scatter graph. I don't know if y'all remember this. And then they added the trend line. And the trend line was your slope and your beta. I don't know if y'all remember doing that in another class. I don't like this approach because I want to know when in history each one of these dots is. So I prefer this over time. I stole this from a portfolio manager from a few years ago. I like this approach a lot better. The other professors are like, why do all your students do this? But I just think it's a lot better than the approach the other classes do. Obviously, they have PhDs, so they're smarter than I am, but I still think this makes more sense for your paper. All right, any final questions? Joseph, you able to get it to work, or are you still working on it? Getting close?
Yes, sir.
All right.
We'll figure it out. We're in college for a reason.
All right. Well, you have the videos, so there's nothing I'm doing here that's that crazy. It's just I'm going a little fast because of time. So, all right. So this video should be out there by tomorrow. I would do it while it's still fresh in your mind. I know you're more worried about papers 3, 4, and 5, but you might as well get this out of the way and just set it aside. So, all right. That's it for tonight. Good night, everybody.